You just flipped the whole mental model in my head with that example from Credit Suisse. Is it a correct viewing of the relationship to say that banks borrow money from their depositors so they can lend it out?
Absolutely.
I never thought about it like that.
I
don't think anyone's thought about it like that. No one says, "Oh, I lent my bank some money."
Well,
but
it's
that
really
is actually the model, isn't it?
It is the model, and in olden times when interest rates were higher, it was a great model.
The attention economy pits you against me. Money makes no sense these days, and the robots are taking jobs. The planet is in peril, but we can set us free. Put our brains together if we lead with our hearts. Gotta take back control from the greedy and the corporate. Gotta take back control to the hands of the people. Collaborate and listen. We learn and we grow. Build the future that we want. Gotta take back control.
Welcome to Tech Back Control Episode 5, where we have a bonus interview following up with Andrew from Episode 4. When we recorded the first interview, it was March 7th, and the events of Silicon Valley Bank, Silvergate, Signature, Credit Suisse, and the whole global banking contagion hadn't really happened. I don't want this project to get into the habit of reacting to the news, but given the timing of this and the topics we discussed in the first interview, I felt like we needed a follow-up, and Andrew kindly accepted my invitation for a second interview. If you haven't listened to the first interview with Andrew, I highly recommend it. We dive into what gives money value, why interest rates are important, and the future of digital money. Now, it's time to enjoy the bonus interview. So, Andrew, welcome back to Tech Back Control. I truly wasn't expecting to be having another interview with you so soon, but it seemed like just days after we recorded the last episode about such a banal topic as, what gives money value, just everything started falling apart. So thank you for your time to come back and revisit this with what we now know.
No problem, Jonathan. And indeed, who was to know that nearly days after I was predicting the end and the demise and associated fiascos with stablecoins, that of course the second largest one broke the buck, as it were, and almost proved the theory. But who was to predict that?
I have to admit, I foolishly thought, we'll record this early on in the month. I'll have plenty of time to launch it. Nothing could possibly change with what money is in that time. Little did I know. So thank you for your time on this. For those people who haven't listened to the previous episode, highly recommend it. But if you're skipping that, maybe if you can just do a quick intro again, just for new listeners.
Sure. I'm the author of the Detocalypse Twitter handle, and I work in the financial services sector, and I've worked in that for a number of years now. And I have an interest in money and finance and some of the topics Jonathan covers on the show.
Perfect. Well, I'm going to jump straight into some questions. So do you mind quickly recapping the events of what happened since we last recorded, which was, I think, the 7th of March? So the last 2 weeks, basically.
No, quite a lot's happened, although in some ways it's not that much has actually happened. But anyway, I think the big thing is clearly that Silicon Valley Bank in the US, which is or was one of the top 20 largest lenders in the United States, with a balance sheet of around sort of $250 billion, remarkably suddenly, I don't know if I want to use the word collapsed, but was sort of put out of business by the US authorities. And why did that happen? I think we can delve into some of the details in a little bit, but I think depositors of that bank became concerned that the bank might not be around for the longer term, and not having a lot of upside for keeping your money in a bank if it's not going to be there, started taking their money out. And I think at one point something like 40 or nearly $50 billion was taken out of that bank in a single day. And it ran out of money. Apparently, I think it had a negative cash balance on the sort of the Friday before it went out of business. And it was shut down. And, that was sort of the start of what's been a sort of a fairly chaotic couple of weeks. And, what happened there was the bank was sort of shut down. Depositors initially were understood that they would get only up to sort of $250,000 each which sounds like quite a lot of money, but Silicon Valley Bank is, really more of a corporate bank, with a lot of corporate customers who would have much more than that typically in their bank account, for payroll and etc. So it looked like something like 90% of its remaining depositors would lose some money, which is not again, when we're talking about the topic of what is money, but money in the bank should be worth 100p in the pound at all times. So it's completely unexpected to depositors that they might lose money. And what we saw off the back of that was a number of other regional banks in the US that were seen to have sort of maybe similar profiles to Silicon Valley Bank, and we can talk what that is, but maybe viewed as the next candidates for a potential bank run, struggled. And, very quickly after Silicon Valley Bank went under, we saw the sort of Signature Bank went down in sort of similar circumstances. So, it looked like there was going to be a bit of a bank run in the US, but maybe to nobody's surprise, the Federal Deposit Insurance Company and the government came out and said, Silicon Valley Bank depositors will get all their money back, and, Signature depositors as well. And that seemed to sort of calm things. But as we alluded to, sort of in the melee of all this, it turned out that we saw that the second largest stablecoin, USDC, which is backed by, or operated by rather, Coinbase and Circle, sort of happened to have $3 billion or more than that of the money backing the coin,
the actual money,
deposited at Silicon Valley Bank. And, what are the chances? The one bank that goes under, it just so happens they have that's where they're keeping their money, coincidence or not. But, that was a real shock to the system. The stable coin should always trade at 1-to-1 to the dollar, dipped down into the 80s. And, it wasn't for sort of the bailout of Silicon Valley Bank and the FDIC sort of saying, look, depositors will get all their money back, it would have been very interesting how that would have played out, but not how stable coins are meant to work. And, a real shocker to the system there. And, then we sort of look what's happened next. I think there's been a lot of share price pressure on other banks, particularly in the US, smaller regional banks that are seen as maybe having deposit profiles that are maybe slightly riskier. And maybe on the asset side, might have similar profiles to Silicon Valley Bank. And, a lot of very volatile sort of share price action in the US banking sector. And then sort of to cap things off, this week, we've seen in Europe that Credit Suisse has been sort of forcibly taken over by UBS, their Swiss rival. And, you could argue there's probably not a lot of read across between Silicon Valley Bank and some of the US lenders that are under pressure at the moment, and Credit Suisse. But I think what we've seen is that Credit Suisse has had problems for a number of years. It's lost money. It's been involved in various sort of scandals. Doesn't appear to have been particularly well managed for some time. And always it seems to be sort of under focus when people are looking at sort of banks that might be weak links in the system. And I think even last October, a lot of people took deposits out of the bank when there were sort of rumours that it might be in financial trouble. That seemed to stop and address itself. But there's been a turnaround, and they've been intending to sell a division for some time, but they've not really done it. It's not been clear exactly how that will play out. And I think investors have just sort of lost patience with it, frankly. And deposits seem to be coming out of that bank. The Swiss National Bank sort of backstopped 50 billion of liquidity. But all I think that did was really make investors clear in their mind that there was a risk to holding money in Credit Suisse. And ultimately, once a bank sort of is viewed that way, it's very hard for it to sort of change minds quickly. The path of least resistance was for UBS to take it over, a much stronger financial institution, better managed, and wind it down and keep sort of only part of it, and get some extra sort of guarantees and liquidity from the Swiss National Bank while it does that. So that's kind of where we are at the moment. We've sort of seen sort of bank runs in the US, and the sort of forced merger of one of the 20 globally significant financial institutions in Credit Suisse.
I mean, the timing of it is uncanny, because when I last had you on the show, we were speculating that why can't a bank issue a stable coin. That would be so much more reassuring for people because, you trust the bank. And the big concern about stablecoin issuers is, I think you were saying, the money's not there. When a lot of the times, especially in the 90s and noughties, these money projects, people would go to use this stablecoin and it would turn out that the money backing it wasn't there. So they suffer bank runs. And ironically, just after we recorded, it wasn't a stablecoin that brought down the banking system, but a bank that managed to almost bring down one of the largest stablecoins. The irony is palpable. I've been looking into this, I'm sure a lot of people have, and there's so much coverage on it around like who's to blame and what the causes were. If I was to summarize it, and you can tell me if this is right, with Silicon Valley Bank and potentially with many other banks, they'd put depositors' funds in long-dated treasury bonds or mortgage-backed securities. And with the Fed increasing rates, the value of those bonds has dropped. And so if they then need to sell them to make good on a depositor withdrawing some money, they end up getting 80 cents to the dollar or whatever it was, and they end up with not enough capital. Would that be a fair summary of at least for Silicon Valley Bank?
Yeah, absolutely, Jonathan. And I think really, when you step back and say what happened and why did it happen, that's a very fair analysis. And we talked about this last week, what gives money value, interest rates, etc. If you take money today and say, well, I'll pay you back tomorrow if you want it back, there's a lower interest rate than if you say to someone, I'll lend you money for 30 years. A lot can happen in 30 years. You need a lot of reward to take that risk. What's a pound worth in 30 years' time? Who knows? What's a dollar worth? So normally interest rates for sort of longer term loans are higher than short term loans, and banks, sort of love that. And that's where they make their money. Ultimately, they, have deposits, whether you get paid, your payroll account, companies, working capital. There's money sitting there that, individuals can't tie up for 30 years. But collectively, the bank can sort of take a view on that money and say, well, we should always have X amount of deposits available. We could lend it out for much longer than, overnight and make some money. So that's what banks do. But equally, they need to manage the risks associated with that. They need to have enough liquidity on hand that if people do, for whatever reason, want more of their money back than expected, they've got it. They need to be able to sort of realise, the value of the loans they've made quickly if they need to. And ultimately, they need to sort of be aware that, they might lock in an interest rate for 30 years with the US government or a US government-backed security, which is, zero risk from a credit perspective. As you say, from a value perspective, could change enormously if interest rates move as they did. And, that's sort of what happened. But I think stepping back, the key context is interest rates have been going up. They were at sort of record lows for a decade, and then they went even lower. And then in the pandemic, they went even lower, and we had, quantitative easing, and people kind of felt, interest rates will stay low forever. And then out of nowhere, within 12 months, we've got, dollar interest rates over 4%, which, nobody was expecting, apart from a few sort of Cassandras. And, it's caught a lot of people off guard, and actually, the value of any security should go down if interest rates go up, theoretically. And it's really a question of where are the bodies buried in that scenario.
Can I just pick you up on that? So this assumption around securities value going down if interest rates going up, I'm sure to people in your world, that's an obvious, everyone knows that. For listeners and people who maybe are completely new to this, we talked a lot about the value of money last time and how it has like a time value if you lend it out. The way I've tried to understand this whole thing at the moment is when interest rates go up, the cost of borrowing money also goes up. That's the price of it, right? But it's also fair to say that more recent debt that's been issued is more valuable than debt that was issued when the interest rates were really low, which is why you see this market forces of 10-year treasury bonds bought 3 or 4 years ago have been really devalued by new debt that enters the market now. That's how I've kind of understood it, because I was like, surely it's the safest thing, a treasury bond. It's guaranteed by the might of the US government. Unless you want to sell it today, in which case there's not many buyers because they want the stuff that was issued yesterday, not the stuff that was issued a few years ago. But it makes me think about this question that I've got, which is that the model of banking services and the economy in general is being worn on the sleeves now. In 2008, it was a much different financial crisis, but now we're not talking about bad actors or lots of risky assets. We're talking about the Fed raising interest rates and the banking system itself, by the way it operates in terms of taking your money and instead of just holding it for you, actually, you basically, by depositing in a bank, you're buying securities. You just didn't know it, right?
Exactly. And I think there's so much to unpick. And I think one of those is how people maybe view the 2007 to 9 crisis. And I think, the narrative today is that, there are lots of greedy bankers who weren't regulated tightly enough. And, left to their own devices, they speculated with other people's money and, the whole thing collapsed. And, there's probably elements of that are not completely wrong, but it misses the key point. And those maybe with a better memory, who were there at the time, remember that what happened in the run up to 2007 was that you had, a really big bubble and a boom, stock market boom in the late 90s. That crashed in 2000. There was, fears that there was going to be a big recession. And then we had the 9/11 attacks. Again, there were concerns that would, impact the US economy more broadly, consumer confidence, etc. And, the US economy was really viewed as quite weak for a period of time. And what you saw was interest rates in the US were dropped to really low levels for about 2 to 3 years. And you had a huge reaction to that. People were looking for investments with higher yields because you think, actually, I can't get a good return in from government bonds or corporate bonds anymore because the rates are so low. And, that spurred a demand for sort of higher yielding products. And that's where you had the growth in these mortgage products, the CLOs, etc., that people really focus on. And what happened, obviously, interest rates started going up. They actually went up remarkably quickly to, over from 1% to 5% in about 18 months or something like that. And, that was the background to 2007. And what happened, what caused the financial crisis? We can obviously write books about it, but the catalyst was, with interest rates having grown so quickly, a lot of the people holding these mortgage-backed products that had, really become very popular, and banks really piling in to grow their sales teams in those areas and build books so they could sell these things. All of a sudden, you had investors saying, well, actually, why do I need to be in this quite complex product? It's quite structured for, 25 basis points over treasury bonds when I could just sell it and get 5% in a treasury bond now. Why am I messing around with this stuff? So there's less reason to buy it. There was more reason to sell it. And, investors started selling these products. And at a certain point, it became harder to match sort of buyers and sellers. And you had sort of big gaps in the market. And people going, well, actually, hang on, this is going to be a triple rate security, but I can't sell it. And people going, well, what's it really worth? Maybe defaults were picking up as well in the background, again, driven by the higher interest rates because the mortgage holders were flipping onto these, there were teaser loans that flipped on to the sort of the base rate after a couple of years. So that was the context. And then, all the things around banking greed and all the rest of it came out of the woodwork. But the proximate cause for the 2008 crisis was a rapid rise in interest rates after they'd been sort of too low for too long. What's relevant from that to today? I guess what we've had now is we've had very low interest rates, not for sort of 2 or 3 years. We've had low interest rates for 15 years. And not just that, we've had, multiple rounds of quantitative easing, a huge growth in valuations in the stock market, tech, other areas, lots of speculation, lots of bubbles. I think some of which have popped, maybe some of them haven't. But what you've got now is you've got interest rates that are going up similarly to how they did in 2007. And I guess the question we're asking is, and maybe we're starting to see, is, where are the bodies buried? What's been happening in the last 15 years that will be uncovered or will look imprudent with interest rates sort of out of nowhere being 4 or 5%. And, lo and behold, they've been there for sort of 6 to 9 months, and we get a bank run. We see that Silicon Valley Bank grew its deposits from double-digit billions to, 200 billion odd in a few years. And what did they do with that money? They were trying to be quite sensible, I think. They were saying, well, we're not going to, invest it in speculative things. We'll put it in treasuries because there's nowhere else we can put it. But they were under pressure to improve their interest margins from their investors. And to do that, they sort of bought longer dated treasuries, which had a slightly better interest rate. But as we've now seen, it exposed them to sort of massive risks if interest rates went up.
We're hearing a lot of people, especially in the news media, a lot of the pundits and the commentators and the people that they bring on, keep using this phrase now where they say that banks are all about confidence. If it doesn't have confidence in the bank, they don't have anything. Can you talk to me about that? Because I don't know whether that was the rhetoric that we've had for the last 20 years, but now it's people are trying to redraw the lines of what a bank is, that a bank is all about confidence. So is that true?
Well, absolutely. I think the whole point of banks, as we said, is you sort of take money and you promise to pay it back on demand, and you actually invest it in something that isn't actually repayable to you on demand, or it's a mortgage, or it's a commercial loan, or a car loan, or whatever it might be. And any bank anywhere, if all the depositors said, can I have my money back tomorrow, it would struggle. That's a fact.
That's
so
a fair point.
It is a confidence game. And I guess why are people comfortable, most of the time, almost all of the time, actually just keeping their money in the bank when they know that? It's a really interesting question, but there's reasons for it and all the rest of it. But fundamentally, if a bank is ever viewed as being even slightly unsafe, there's no reward to sort of being loyal or keeping your money in that bank. You might as well just take it out. So that's why these bank runs happen, and they happen so quickly. And again, we saw with Credit Suisse, they were starting to pay, really quite high levels of interest for deposits. And that in itself, became a bit of an issue where people were like, well, how can they pay 7% for 6 month money or whatever it was? It was something like that. And really, they couldn't. They would lose money that way. But the alternative is they would not have the money overnight when they needed it. So, they were really caught in a bind. But you can't attract your deposits by paying a high price, because that will put people off putting money in ultimately, because they can kind of realise you can't afford that. You can't pay me more money overnight than you can lend for 10, 20, 30 years. You can't give me a better return than you're getting. Well, you could offer it, but you'll lose money. And then you definitely won't be able to pay your depositors back.
You just flipped the whole mental model in my head with that example from Credit Suisse. Is it a correct viewing of the relationship to say that banks borrow money from their depositors so they can lend it out?
Absolutely.
I never thought about it like that.
I
don't think anyone's thought about it like that. No one says, "Oh, I lent my bank some money."
Well,
but
it's really
that is actually the model, isn't it?
It is the model, and in olden times when interest rates were higher, it was a great model. I mean, the problem at the moment is not so much that interest rates are higher, which should be good for banks. It's that they've moved so quickly. I think if the moves in interest rates had happened over sort of 3 or 5 years rather than sort of 9 months, then the banks would have adjusted. There would have been less volatility. They could have managed these things. And again, from a banking perspective, you can pay a lot of your depositors next to nothing. A checking account, money that you just need overnight. You're not too focused on the interest rate you get. So if interest rates are 1%, you probably can offer your depositors 0. But you can't really make much because you're only lending out at 1% plus whatever sort of margin you charge on top. Higher risk borrowers might pay 6-7%, lower risk might pay 2%. But net, the bank's not making much money on that because, they have credit losses. Sort of wash their face on the margin they charge a borrower, Where they make money is in sort of taking money from you at 0% and lending it out at 3, 4, 5% and then putting a margin on top. And the 3, 4, 5%, they say, well, that's the cost of money. That's what it costs to borrow for, 5 years. But, I need to charge you an extra 2, 3% on top for your mortgage or your car loan or your credit card because, you might default. But if interest rates were lower, they're still charging the same margin, but they're just making a lot less sort of easy money. And, that's why if you look at bank share prices after the financial crisis, if you take investment banks away, you make money in a slightly different way. But commercial banks, the share price performance has been terrible because it's just very hard to make money. You sort of borrow it at 0, lend it out at 0 plus a margin. You've got to be very good at lending money to make money that way.
That's really interesting. I'm going to move on to a topic that we covered last time because it's evolved so much. In the last interview, we talked a little bit about stablecoins and I think we went into more depth about what they are. But given what happened to USDC and the fact that it lost its peg to the dollar, dropped down to 86 cents, I think, at one point, briefly, until it's come up to parity now and I think there's a lot more confidence in it. But does this inevitably lead us towards a central bank digital currency, especially in light of the fact that most banks aren't marking things to market? If their value of their liabilities are actually lower than what they would be because they're 10-year treasury bonds, they should recognise that as a loss, as opposed to, no, don't worry, in 10 years it'll make good. Does it put more pressure on at some point having a central bank digital currency that solves all of this, but with massive surveillance risks?
I think there's a few things there, and I think probably for me the biggest development in the last sort of 2 weeks has been that the Federal Deposit Insurance Company in the US and the government has effectively come out and said that all depositors in Silicon Valley Bank and Signature Bank will get their money back. And it's not meant to work that way.
Why?
That is a good question. I think Joe Public would say, well, I put my money in the bank, I should get it back. I can't really oversee what the bank's doing. There's no incentive for you to sort of trawl through the annual accounts of a bank and go, oh, well, this one looks a bit more risky than that one, I'll take the money out.
Well, even the regulators missed it, right? So how would a normal Joe Blocks go?
Exactly. And I think there's an argument there that there's a sort of a market failure and the people can't sort of do that work themselves. It'd be hugely inefficient if everyone was just spending all day reading 20 different annual accounts from the banks to sort of figure out where they should put their money. But equally, the problem is that if people put their money in the bank and say, well, if the bank goes wrong, goes bust, the government should bail me out. That's not particularly fair on people who maybe didn't have their money in that bank and they're sort of paying for its failings when, they didn't get any benefit from it. And
well, no, the depositors didn't benefit. They just didn't take a loss, right?
Again, it's very interesting. I mean, and I think that for me is an interesting statement, Jonathan. I think why, if you're putting your money in a bank and it's offering you sort of 6-7% interest, and there's a much more sensible bank down the road that's only offering sort of 2% interest, should you maybe think, why can this bank pay me such a high level of interest?
I don't think Silicon Valley Bank was offering very good interest rates at all.
Right,
in fact, some criticism I've heard of it, if they'd actually passed on the interest rate that they are getting from the Fed to their customers, their depositors wouldn't have withdrawn stuff to go buy treasury bonds, which might have stopped the withdrawals. So I don't know. I just don't know whether there's this idea. If you want confidence in any bank, you need to reassure depositors. Otherwise, the only answer is, if I'm a depositor, I'm not going to read the terms, conditions and bank balances of every bank. I'm going to go to the biggest bank there is and just the one that's systemically important and just use that one.
It's a really good point. And I think this is where it's almost a bit back to front at the moment. And people assume they should put their money in the bank and it is risk-free. There isn't any risk whatsoever. And then when a bank goes bust, it's like, oh my God, I might not get my money back. And there's reasons why the government doesn't want people to fear that, because they don't want bank runs, and nobody wants bank runs and all the rest of it. But equally, people should maybe understand that their bank isn't just putting their money in a big safe somewhere and will give it back to them when they ask for it. It's not a safe deposit box with their money in it, that banks are commercial entities, they are borrowing the money from you, and there is a risk that, the bank might not give you your money back. And I think more and more and more, through precedents over the last week and what's happened during the financial crisis, and also what happened in the 80s in America in the sort of savings and loan crisis, and there have been times before that. But people generally, I think, just assume the government will stand behind the bank and give them their money back. And the problem with that is really, what's the point of a bank if the government stands behind it? Why shouldn't it just take really risky bets and try and make some money? Depositors won't lose out.
The government didn't stand behind the bank, though. Anyone who had equity in Silicon Valley Bank is wiped out. Anyone who had equity in Signature, wiped out. Silvergate, wiped out. I think there's a difference there between investors versus depositors, right?
There is, and you'd think if you're a bank shareholder, you'd be like, well, hang on, guys, let's manage this thing sensibly. But equally, you can't ignore the fact that the government, by sort of effectively standing behind every depositor, should really and rightly say in that scenario, well, you shouldn't take much risk. And actually, we should really control the risks you're taking. And this is why I sort of mention it, because if you sort of start taking that view, that the reality is the government stands behind deposits and, no depositor will be allowed to lose money. If that's the reality, whether it's the law or not, then, really, what risks should banks be allowed to take? Commercial, they make a commercial view that they think this is somewhere to put the money or whatever. The government really maybe second guess them and say, well, no, that's a little bit high risk. And I think if you look ahead, you look through the implications, you're turning banking into a utility where the banks shouldn't really be able to run themselves the way they see fit and in a sort of commercial way, where everybody's on the same page, so that depositors might lose money, shareholders might lose money, but equally shareholders might make money and depositors shouldn't lose money. I think we saw a huge amount of regulation come in after the financial crisis. Banks' risk-taking has been lowered, and ultimately, as a huge sector, are we actually seeing the sort of the beginnings of a central bank sort of digital currency? And this is what I'm thinking. If you sort of almost take away the sort of freedom of banks to sort of raise deposits and lend the money as they see fit, if you start saying, well, no depositor should ever lose money in any circumstance, then what's the only way to achieve that? It's probably not to allow banks to sort of lend money out and use deposits to sort of fund their lending. You should probably say banks should raise money in the money market if they want to do that, and people should just have deposits directly with the central bank.
If you don't protect depositors, that's what you ultimately end up with, right? Because like I said, if I'm a depositor, I'm not going to study every bank, just like I don't read every terms and conditions sheet for everything I click OK to. But with money, like you were saying, its value is that ability to buy stuff with. Well, if I'm going to, as we discussed, if I'm lending my money to a bank, I might as well just lend it to the biggest bank in the nation.
Well,
if you're not going to guarantee that my money's my money. And the alternative to that, and it's a topic I do want to get your view on, is the podcast I do with Doug. He always jokes, like, with Bitcoin, when Satoshi Nakamoto created Bitcoin, it was to create an alternative form of money and take back control of money in the financial system. And we always joke that you can be your own bank, but don't be your own bank if you're going to be a bad bank, basically. So if you don't know how to handle, your keys or your seed phrases or any of the stuff that is important in terms of securing your own Bitcoin, don't do it. But now you're telling me, well, actually, I've got more likelihood of looking after my own cryptocurrency and being my own bank that way than to entrust a bank. Where does that leave things like, whatever you want to call it, decentralized money, cryptocurrencies, self-sovereign money?
Well, I think it leaves it in a very interesting place, because I think the role of banks, and particularly if the sort of current crisis maybe escalates, ultimately banks are viewed that they should not have the autonomy to manage deposits as they see fit and to take risk with deposits. If that's viewed as something that's sort of a problem, we have the technology now, and I think there's a lot of momentum, a lot of people looking at this, that people can just hold their deposits directly with the central bank. And, from a regulatory perspective, that solves a huge amount of problems. And, maybe banks, maybe they've reached the end of the road with deposits. Maybe it's not the best way to fund banks and lending in an economy. Maybe banks should, raise money from pension funds, insurance funds, and say, look, give me your money, and don't give me overnight. Let's get rid of that pretense. I'll borrow the money for 5, 6, 7 years, and I'll lend it to mortgages. I'll do whatever it might be, and everybody's on the same page. The insurance funds, whatever, they might think, well, hopefully I get my money back, but I might not. And maybe banks fund themselves that way. And Joe Public doesn't need to get involved in that. He gets his wages into a central bank wallet. Nothing to do with banks, no risk. They're not lending that money anywhere, and he's happy. Joe Public's money's safe. It's not being used by somebody for something. It's not being lent out. Somebody's not making money off his money. And, if he wants to get, a rate of return from his savings, he can give it to a bank and get a return through some sort of product, 12-month deposit or whatever. Maybe that's where things are heading. But I don't think you can have a sort of banking system which, on the one hand, says, banks do their own thing. They borrow money from depositors. Your deposits are at risk. And on the other hand, the government stands behind every deposit in the market and says, well, no matter what happens, you'll get your money back. Because fundamentally, I think, how does that work? Why shouldn't every depositor just chase the highest returning bank account in that scenario? And that will sort of encourage banks to be, less prudent, and will reward, the worst behaved banks maybe that are chasing the highest returns.
I see what you mean. There's an interesting idea around whether the future of money involves banks becoming utilities. And I think, are you familiar with certain decentralized finance protocols? So Compound and Aave, or just the idea of how they work. So on the blockchain, a smart contract that just allows you to execute lending money or borrowing money, basically.
They're very, very interesting, actually. And I think the key point with those things, it sort of recognises that money has sort of two features. One is, do you want it as a store of value that you just want to access for sort of purchasing power? In which case you don't want to take any risk with it. I don't want this money to be lent out to somebody that might not pay it back. Or are you using your money to sort of as an asset, and you want to access assets with money to get a return in the future? So you've got sort of more purchasing power in the future. There's two really distinct uses of money that the current setup with banks doesn't really distinguish. You're sort of almost forced to get an interest rate when you put it in the bank. You put it in your savings account, and you're like, oh, okay, well, in your current account rather, and you get 1 or 2% interest. You're like, well, I don't want that. I'd rather just keep the money safe. Where's the choice for that?
With these DeFi protocols, they act very much as utilities. So as a result, they're over collateralized. So you don't have fractional reserves. You have fully reserved or over collateralized smart contracts, so that you can't be caught in this situation. and if there is a situation where your assets, when they're marked to market real time, go below the value that they need to be for collateral, you're liquidated. So it's it executes itself as a utility, but as a result, the interest rates you get from borrowing or lending is very efficient and is very low because they can't offer that much more, because they're not doing much more with the money other than someone else borrowing it, someone else lending it. I'm interested in that and I'm probably interested in it more than ever as a result of the last few weeks, and even this conversation, that the concept that I'm lending my bank money is anathema to me. It's genuinely like someone broke the simulation and I've just realised that's what's going on. But when you think about it like that, it makes it much easier to make the leap to, hold on, I could probably be my own bank. Not for everything, obviously. You might still want the services that a bank offers you day to day in the economy, but for your savings or for other things where you want more control and reassurances, actually, I'm starting to think being my own bank in decentralized finance, whether it's with Bitcoin or Ethereum or any of the things that are out there, is starting to look a lot more attractive. I don't know how you feel about that, but...
No, I mean, I really, I increasingly really question the role of banks, and particularly with the amount of regulation they have now, and the fiction that they are sort of independent entities, when actually it's sort of like more and more areas are sort of constrained by capital requirements, certain regulations. You're seeing now banks, when they lend money, they have to be sort of certain that, the sort of climate risk is taken into account, and things like this, which, you may or may not agree with in terms of public policy. But again, there's less autonomy in the banking sector. And you see, the idea that bankers should get sort of high bonuses or anything like that was, hang on, you're only getting that because the government's sort of backstopping you, and that's lowering your cost of funding, and you can sort of make lots more money that way. Yeah, that might be true. But again, it's sort of the whole thing points to a sector that is a little bit Wile E. Coyote. He's already off the cliff. He's already, the argument that they should be able to do what they want has been lost. And it's just a question of how far governments are willing to go in constraining their activities. But equally, I think, when you look at banks and how important they are within an economy, they're hugely important. They lend mortgages, commercial lending, invoice discounting, trade finance, so many different ways, they fund acquisitions of companies and all these sorts of things. It's not a 5-minute job to sort of replace that role and that expertise that the banks have. They've gained over decades and centuries through non-bank actors. And I think this is why we'll see a transition over, sort of decades, I think, where some banks probably will choose to try and maybe not take any deposits. They might think, well, actually, we can fund ourselves differently. And if you're not funded by deposits, why should you sort of do what the government tells you to do? Maybe that will be an argument that comes in. Increasingly, actually, we see non-bank financial institutions, credit funds, in particular, who can be gigantic, with over $10 billion in a fund, increasingly replacing banks in lending to certain parts of the market. You see in leverage finance, I think 70% of the market is now served by credit funds. They're not banks, but they lend money, and they raise money from institutional investors. We were sort of touching on before. They raise money from pension funds, insurance companies, high net worth individuals. They say, well, raise a fund of, say, 5 billion euros or pounds, or whatever it might be. And, we want to lend to companies of a certain size and, whatever it might be. And, they lend the money, they charge a certain interest rate, and they give the return to their investors and keep a portion of the return for themselves.
That's interesting.
And that's something that's there. It's a huge part of the market, particularly for leverage loans, funding sort of private equity buyouts. And you're starting to see now actually even really large, billion plus loans are being managed by these funds, often working together. So, it's out there. Banks are being disintermediated. And, banks probably put money into these funds from whether themselves or on behalf of their clients. But it's just one example of this is happening. And I think over time, more and more of what banks do will be done by your sort of non-bank actors, or banks will sort of really shrink the deposit base because it's not helpful to them to be an important deposit holder.
Well, on that note, I think we can wrap up, but it's been eye-opening, actually. I'm glad we did a second interview following the last time. Real pleasure hearing your thoughts on this ever-changing market. So thank you.
No problem, Jonathan. I'm happy to be on the show, and really interesting, as always, to sort of talk through these topics with you.
Great. Thanks, Andy.
Thanks, Jonathan.
So you're back with me, Jonathan, to wrap up. It's truly astonishing to realise that I'm effectively lending money to the bank. And if there's one takeaway I have from this interview, it's that I am more convinced than ever that the opportunity to take back control over our money exists now. I'm not sure whether that's going to come from Bitcoin, decentralised finance, or some other secure financial constructs that aren't necessarily traditional banks. What is clear is that the current system just isn't working. Big thank you to Andrew for agreeing to come on and do a follow-up interview after the recent events. You can follow him at the Detocalypse on Twitter and Medium. I'll leave links to socials and writing in the show notes. As always, if you enjoyed this episode, please leave a review on whatever podcast app you're using, and if you want to get more involved in the conversation, feel free to join the Discord. This episode was recorded and edited by me, Jonathan Tipper. The theme song is by Jonathan Mann, and the backing soundtracks are from Epidemic Sounds. The artwork for this week's episode was created using Midjourney, using a chart of historical interest rates Andrew provided. Thanks for listening, and I'll catch you next time.